up, guys? I'm Mike D'Antonio, founder and CEO of StockedUp. In this video, Tom and I are going to be showing you guys how to find the best dividend stocks to buy. And we're going to be also showing you guys some example dividend stocks that we like right now. So we have a list of about like 10 different stocks that we like and some explanations of why. So in this video, we're going to be explaining, why we like them and how we found them. So just like a quick note, both Tom and I get a ton of questions on a daily basis asking, what makes a good dividend stock? And people often fall into the trap of, they might find a good penny stock with a 15% annualized return, or at least it says that. But you guys have to be very careful with certain dividend stocks, like for example, ET that Tom has pulled up right now. Some companies are going to tell you that they're going to pay a 25% dividend or even higher. But guys, really understand that dividends are not guaranteed, especially by like fraudulent companies or just companies in a bad position. So a huge criteria for both Tom and I is to make sure that we are investing in companies that are going to be around for the long term. Because after all, dividend investing is not going to make you rich in the short term, but it's more of a long-term approach. And it's super important that you are investing your money in a reputable, solid company. So that's just a quick note. And with that being said, Tom, if you want to, get us started with the first dividend stock. And guys, we're going to show you how we scan for dividend stocks at the end of this video. So make sure you stick around.
Yeah, Mike. The first dividend stock is going to be AT&T. Ticker symbol is going to be T. And they are a very good company for the long term with a lot of good outlooks. They are getting into some 5G applications, which is going to be exploding within the next 10 years, 5 to 10 years, I'd say. They're starting to build a whole bunch of towers and create the infrastructure for it right now. And AT&T is also very low right now. They were at highs of 44 before the coronavirus happened, and they ended up falling all the way down to $27 a share. And I actually picked up 200 shares of them. And if we go back to the long term, you can see that they've pretty much channeled between like 27 and 40 for the past few years. And they're just a solid company, and they're always going to be around because they make cell phones, and obviously everybody needs their cell phones.
And like Tom said, guys, AT&T is a good company overall. They have, good services for personal and business use. They give about a 7% annualized yield. They have a solid history. And like Tom said, there's a lot of growth in them, especially in their 5G aspect of their business. And then Tom, if you want to talk about ABBV.
Yep, ABBV. What do they do, Mike?
So ABBV is a drug company almost. They're heavily in the.
Yep, that's what I thought.
Yeah. So ABBV is definitely in the healthcare industry, and they actually just made a huge acquisition lately of Allergen, which was another big stock. ABBV has a ton of cash as a company. They're just doing great. They're acquiring a lot of their competitors. They pay a great dividend of 5%, which is amazing, especially coupled with that growth that they offer. So they offer amazing growth, and they're doing good as a company. So I really like ABBV, and honestly, I like them as one of my top stocks.
Yeah, me too. I've definitely been watching them from a technical standpoint for a long time, and I've been seeing their growth over the past few years, and it's been outstanding. I can't believe it, and I cannot believe how high of a dividend they pay for the growth that they've been having. It's just insane because normally, stocks with higher dividends are normally stocks that have been falling lately or lower priced, but ABBV's just maintained it this whole time.
Yeah, exactly. So I really like ABBV. And then, on to the next one with CocaCola. CocaCola, as you guys know, has been around for forever. They're most likely to be in business for the next however many years. They're a solid company overall. Warren Buffett has a huge position in them. They're a value stock. You're not going to get great growth out of them like you might with ABBV, but Coca-Cola is just one of those safe ones. They're definitely a good aspect to have in your portfolio.
Yeah, definitely. And like you said, they're just never going to go out of business. Everybody is going to drink Coke. They have huge contracts like with McDonald's and Burger King. And those are big things, guys. And McDonald's right now is doing very well. So that's going to be good for Coca-Cola as well. I know Coca-Cola was 60, but now they fell down to 45. But guys, with a solid company like this, just imagine that you're getting at a solid discount, like a $15 a share discount.
Yeah, that's crazy. You know what I mean? So, obviously, there are a lot of bad things that did result from the coronavirus, but one positive is that you could get some great companies at an amazing price right now, especially companies like Coca-Cola. So that's another great one. And then, Tom, if you want to talk about LEG.
Yep, LEG is Leggett and Platt. They're also a very good company. They like to make office equipment, kind of like beds, office chairs, shelving, and stuff like that. And they are a dividend aristocrat, which means that they've increased their dividends, I believe, for over 25 years in a row. But Leggett and Platt has increased theirs for 49 years in a row. And they are very low right now with the coronavirus going on. But they have maintained their dividend, and they still have a decent outlook for the future, and they're still profitable in their earnings, which is very good to see during the coronavirus. So I think that they're definitely a stock to buy. And I personally have like about $5,000 invested into Leggett and Platt for the long term within my dividend portfolio.
Yeah, I feel like Leggett and Platt offers like that nice, like happy medium of growth and safety because on one end you have what do you say 49 years of increased dividends or
Yeah,
45? Um,
49.
49 years of increased dividends. That's crazy. They've been around for forever, and you're also getting them at a great price right now. So I feel really good about that play too. And then Tom, if you want to talk about Triple M.
Yeah, 3M, they are an amazing stock who make a whole bunch of things. They make tapes, boxes, adhesives. They have tons of factories that can make almost anything. And what's really important right now is that they make the medical N95 masks, and they have been getting into respirators as well. So that's very good news considering the coronavirus and how much they've dropped over the past few years from $250 down to 140. And you can see how much their growth has been over the past few years. So of course we were looking for this drop, and I actually ended up getting in right around 158 a share. So I'm holding 3M as well.
Yeah, for sure. They are a Dow stock too, which is good. They're a good stock overall. And then we have LMT.
Yep, Lockheed Martin. They are a aerospace and defense contractor who has multiple contracts with different governments around the world. But the thing is that they make some of the best jets in the world, and those are exclusive to the United States. So their best jets are only contracted with the United States, but they're a very good stock with a 2.60% dividend. And you can see their growth over the past few years has been fantastic, going from 100 all the way up to 400 a share, which is very good. Just keep in mind that they are kind of like Boeing in a sense, but they do not do any type of public stuff. Boeing also made some jets as well with government contracts, but Lockheed Martin makes specifically government contracted jets.
Yeah.
And they make very good ones with a lot of technology in them, like stealth capabilities and stuff that no other country can get besides us.
Yeah, so they have obviously that competitive advantage, like Tom mentioned. But look at the growth alone in the past 7 years. Went from below 100, went from lows, went from $66 to highs of 442. Right now we're sitting at about 370. So amazing growth plus the dividend. Awesome play, and then they have a competitive advantage, like Tom said, of the obviously the superior technology. And then we have Exxon and Mobil.
Yep, Exxon and Mobil. Almost everybody and their brother knows Exxon here. You just go to the gas station.
Yeah.
Half of them in the world are Exxon. So,
Yeah, it's crazy.
yeah, they're very low right now as well, and that's just because of the crash of oil. Obviously, everybody remembers when the oil futures went into negative territory a few weeks ago.
Right.
Yeah, so that just sent Exxon and Mobil way down below their 1,000 SMA here. And with how low they are right now and oil kind of resurging back, I think in the long term, Exxon and Mobil will be another good stock to have, as well as Chevron and other oil stocks like that. But Exxon and Mobil pays a 7.8% dividend right now, and they might cut that in the future. But it's something just to look out for, because a 7.8% dividend, guys, that's a pretty high dividend. And like we said at the beginning of the video, you don't want to get caught with your pants down with these high dividend
Right.
stocks.
Yep.
But whenever it's something like Exxon and Mobil, it's something that is a good company long term, and they have a fairly decent outlook considering the price of oil. Oil's back up to around $32 a share or a barrel now. And I think ExxonMobil could definitely see growth in the future. So this one, it's not something you would want to put your whole portfolio into, but it's something that has the chance to go from 44 all the way up to 70 to 80. And that's 100% gain while making a 7% dividend.
Right. So, guys, with Exxon and Mobil, I definitely would not weight too much of your portfolio in this play. Just considering, the recent pandemic crisis thing, and then the oil thing, and all that, blah blah blah. Exxon and Mobil, they're a great company. They're a Dow stock. They have a good history, and their dividend right now is 7.8%. And they might cut that in the future, like Tom said. But even if they cut it by, let's say half, it's still going to be like what, like a 4% dividend. Like, that's amazing. So like, even if they cut it in the future, there's still a lot of value behind the company. It's still a great dividend, and the opportunity for growth is among the best of this list, besides ABBV, in my opinion. And then next we have Hershey's. So, I hope you know what Hershey's is. They make chocolate,
Yeah.
obviously, but they also had, quite honestly, like unexpected growth in the past 10 years. I was not expecting this much growth from a company like Hershey's. They're very consistent. They've been paying dividends for forever. They've been around for forever. And my favorite part about Hershey's is that they are recession proof. Whether the economy's booming, people are still going to buy chocolate, or whether we're in like a depression, people are still going to buy their products. They're always going to be buying it. I feel like Hershey's is doing very well right now. They're not too expensive, and they pay a good dividend, and they're not going to explode your portfolio up like ExxonMobil or AbbVie might, but they're going to be like kind of like a mix between a safe stock like Coca-Cola, but also provide that good growth in it too. And then next we have CL, Tom.
Yeah, CL, which is Colgate. They make a whole bunch of toothpaste and mouthwash and stuff that people have to buy on a daily basis to, keep your self-image looking good. And and you can see they've had great growth as well, going from about $35, $36 a share all the way up to 77. So it's not growth like you see out of other things like Hershey's or like AbbVie, but it is decent growth. And this is another very recession-proof stock because people need this stuff. And it's a stock that has pretty much maintained a channel over the past like 5 to 6 years, guys. And that's what you want to see out of a dividend stock, out of a safe one. And they do pay a low dividend, 2.4%, but that's because they're a safe stock. And keep in mind, guys, that whenever companies are paying you dividends, they're paying you a portion of their profits.
Yeah.
So them paying only 2%, you could look at it in a bad way or a good way. But in the good sense is that it's 2%. They're reinvesting a lot of their profits, and you can see this is what you want to see, a nice sideways trend. And this is a stock that you could put more of your portfolio into because it is recession proof.
Yep. And then we have LLY, which is Eli Lilly. This would be a good stock to like get that exposure to the healthcare industry right now. Like, they're in the business of like the drug industry and healthcare and stuff like that. They're a little bit expensive right now. They have a great history. They are also a dividend aristocrat, meaning they've been increasing their dividends for like the past 25 years. It's not going to explode your portfolio up. It's going to be kind of like one of those more safe stocks, not as safe as Coca-Cola in that sense, or Hershey's, but it's going to be, it has more potential for growth too. So 2% dividend, it's a little bit pricey right now, but I do like it for the long term. And I really like their industry too, the healthcare industry. It's been doing very well recently, and it should continue that in the future. And then last but not least, we have Verizon with a 4.5% dividend. So Verizon is also one of those very safe stocks. They're consistent. They're not going to explode your portfolio upwards. They're kind of like AT&T. They have a great history, and they're very, very like liquid in the sense that they're not going to be too volatile. They have a lot of outstanding shares, and they're consistent. They have 5G working for them, and they have a great dividend too. I feel like they're pretty well priced right now, and especially for that 4.5% dividend, I really like it.
Yeah, I like their channel, and I love how they've increased a slow and steady 100% over the past 10 years. And that's what you want to see, guys, because keep in mind, you're not going to be buying these dividend stocks and then selling them right away. You're going to be buying them and holding them for the long term.
Yeah.
Because like, look at these charts over the past 10 years, guys. These stocks are going from 28 up to 58 over the past 10 years. Who says over the next 20 years that they couldn't go from 58 all the way up to 100 plus?
Yeah, exactly, exactly. So now Tom and I are going to show you guys how to scan for your own dividend stocks and how we scan for dividend stocks. So here is our custom scanner right now. It's completely free. All you have to do is go to finviz.com, finviz.com, then head over to their screener tab at the top. And then, guys, this is our tab. So what we like to do is, one, we like to make sure we're only investing in market caps that are about over $10 billion. You know, you could go a little bit lower, a little bit higher, but when you get into the lower levels, you're going to get exposed to a little bit not as good quality companies. And, you know, if I'm investing in something for the long term, I want to make sure my money is as safe and just protected as possible. Then
Yeah, definitely.
the next thing we have is average volume, which is 750,000. Over 750,000. This isn't as important, but it's just kind of like a little like personal thing. Basically, it just means that we're trading in a liquid company, but pretty much all of the stocks that have 10 billion market caps are liquid companies. So that's just like a little thing that we put in there. And then last but not least, we have the country, USA. This is very important in our perspectives because we want to make sure we're only investing in companies based out of the United States. You know, some people might invest in other countries, but for me personally, I only want to make sure I'm investing in companies from the USA because, you know, I know this is a little bit exaggerated, but, you know, you look at Luckin Coffee, LK, they were reporting some false information and they went from $30 down to $1.39 because they were lying about their profits. You know, everyone saw them as a huge growth stock. When they IPO'd, they went from $25 all the way to highs of $51. And people are saying they're going to be the next Starbucks. But now look at them. They're at $1.39 and they're going to be like delisted from the NASDAQ. So that's just a little thing that me and Tom like. But Tom, if you could go back to the screener real quick. Guys, you guys can customize this however you want, but on our screener, Tom's going to show you how like we find some good stocks. So go to the financial tab, and then you could see when you click that dividend bar right there, that will sort the entire list by dividend from highest to lowest. So we like to do is sort it from highest, but you could look at like ET. So Tom, if you want to talk about ET, it's showing like a 15% dividend, but Tom, if you want to talk about like why that would not be a good trade.
Yeah, definitely, guys. I actually learned the lesson the hard way with ET back when I first started trading. And ET, they do have a nice dividend, about 15%. And most people would think, wow, I can make 15% a year holding this stock. But look at the chart for ET. If I pull up the chart, it doesn't even matter if you're making 15% a year whenever you're losing over 50% year over year on a stock. And
Right.
the reason that they have their dividends so high is that they want people to buy the stock.
Right.
They want people to buy it and hold it. And that's exactly why it's so high, because it's almost like they're trying to play with people's play with their minds. You know, they're
Yeah.
saying, look, we're going to offer you 15% to hold our bad stock for over a year.
Right. And the thing is like it's at $8.20 right now. So by a year from now, this stock might be at like $4. So you might be getting a 15% return on the dividend, but you lose 50% on the actual investment in the stock.
It was at $4 a few weeks ago. So
Oh my God. Oh my. Yeah. So definitely consider that. And then guys, remember, these companies can just say, hey, we're stopping our dividend payments at any time. So keep that in mind. So this is why we like to invest in like the top dogs.
yeah,
So
and one of them that just stopped their dividends is Boeing.
yeah, I mean, I honestly, I kind of like Boeing for the long term. I don't love them, but I like them.
I love them for the long term too. I love Boeing, but I cannot believe that they cut their dividend completely. I thought that they would keep it around like 1 to 2% maybe.
I mean, honestly, you know, I agree with you. I would think they would at least continue to pay their dividend, but part of me is kind of happy that they are stopping that because they're doing what's best for the company. Like if they're paying a 1% dividend and it hurts their company and it might hurt their chances of really growing after this pandemic, then, you know, I would just say, hey, cut the dividend, and I would rather like have the appreciation in the stock. You know what I mean? So
Yeah, great point, man.
So that's kind of like how I look at it. So Tom, if you want to go like maybe like the second or third page, just like show them,
Yeah,
just like kind of like how we would look. So like we would look in this category, like we're looking at a bunch of good stocks right now.
like there's Verizon.
Verizon's right there where they all have about 5% yields. AVGO's in there, Citigroup's in there. That's good, and they're good. So these are all solid companies. Whatever you do, make sure you do your own due diligence. Generally, you want to make sure that you're investing in strong, reliable companies that are increasing. You never want to catch what's called catching a falling knife and just buy stocks that are getting hammered. So don't do that. So with that being said, Tom, do you have any last minutes, anything for this video?
I think that's it, Mike.
Okay, awesome. So guys, I really hope you guys learned something from this video. Just remember that dividend investing isn't going to make you rich in a short period of time. It's a long-term approach. And honestly, guys, the best advice or just tip I could give you is don't fall for, companies like ET where they're saying they're going to give you a 15% dividend or like a penny stock that's paying a dividend. Like, guys, invest your money and do whatever you want because it's your own risk. But I highly, highly, highly recommend that you invest in strong companies. Invest in companies that are going to be around for the next 10 years. Like Warren Buffett said, only invest in a company if you're okay with not being able to close that position out for 10 years. I feel like that completely changes things. And just keep that in mind, guys. And if you guys have any questions or want us to go over any certain stocks, let us know in the comments down below. We're going to be answering every single one of your guys' questions. So I hope this video helped you. Please share it and don't forget to subscribe if you're new here. Both Tom and I post daily stock market analysis videos on the YouTube channel. So don't forget to subscribe. Other than that, thanks for watching.